Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate talk to see what's really going on behind those big announcements. Today we're diving into a filing from the Federal Home Loan Bank of Pittsburgh, and let me tell you, it's not your typical quarterly earnings report. We've got some interesting details on how they fund themselves. Before we get into the nitty-gritty, if you like getting clear, no-nonsense breakdowns of these financial documents, you know what to do, hit that subscribe button. And for more exclusive content and to join the conversation, our Discord community link is in the description below. Alright, so what we are looking at here is a Form 8. Think of this as a public announcement for significant events that happen between a company's regular financial reports. This particular 8K from the Federal Home Loan Bank of Pittsburgh, or FHLBank Pittsburgh as well call them, filed on the 7th of January 2026, is all about their funding strategy. Now, FHLBank Pittsburgh is not your average bank. It's part of a larger system of 11 federal home loan banks across the country. Their main job is to help fund mortgage lenders and community development projects. They get a lot of their money not from customer deposits, but from selling debt in the financial markets. This section tells us about how FHLBank Pittsburgh creates financial obligations. Essentially, they issue what are called consolidated obligations. These are like bonds and discount notes that they sell to investors. The key thing to understand here is that these consolidated obligations are not just the responsibility of FHLBank Pittsburgh, but they are the joint and several obligations of all 11 federal home loan banks. That means if one bank defaults, the others are on the hook to make it right. And this is a crucial point. While they are part of a government-sponsored enterprise, these debt securities are explicitly not guaranteed by the US government. This means investors are relying solely on the financial health of these 11 banks. Now, the most interesting part of this filing is what is attached, which is Schedule A. This is where they list the specific debt offerings they plan to issue. They're telling us about the bonds and discount notes they are committed to issuing. They are excluding short-term discount notes that are just part of their day-to-day operations, focusing instead on the longer-term commitments. They also note if they are taking over the primary repayment responsibility for debt originally issued by another federal home loan bank. It's also important to note that they can change how they report this information. This means keeping up with their filings is key to understanding their funding. They mention that while issuing these debts is important to them overall, they are not making a judgment call on whether any single issuance is particularly significant. This can make it a little tricky to pinpoint the impact of one specific deal without seeing the full picture across all issuances. This is also a very important disclaimer. Schedule A only lists the debt issuances themselves. It does not include any of the financial tools like interest rate swaps that they might use to manage the risks associated with these debts. These hedging strategies can significantly affect their actual financial performance. Lastly, the amounts listed in Schedule A are what's called the par value or face value of the debt. This is not necessarily the same amount that will show up on their official financial statements. That is because the actual amounts can be affected by things like discounts or premiums they offer when selling the debt or other accounting adjustments. So, while Schedule A gives you an idea of the debt being issued, the full financial picture is in their other regular reports. The real meat of this filing is in Exhibit 99.1, which is Schedule we've been talking about. This is where they list the actual debt they are issuing. For example, you'd see details on bonds and discount notes, their maturity dates, and the amounts. Let's imagine we're looking at this schedule. Wednesday sees specific dollar amounts for bonds maturing in, say, 5 years, and for discount notes maturing in 18 months. These figures represent significant capital the FHL Bank is raising to fund its operations and lending activities. For instance, if Schedule A shows an issuance of, let's hypothetically say, $500 million in bonds, that's a substantial amount of money they are committing to borrow. This helps them meet the demand for loans from member institutions. The FHL Bank system as a whole plays a vital role in providing liquidity to the housing finance market, and these issuances are how they generate that liquidity. Understanding the volume and maturity of these consolidated obligations is key to grasping the FHL Bank's financial strategy and its capacity to support its member banks. And finally, at the end, we see the signatures confirming that the report has been officially submitted. This particular report is signed by Edward V. Weller, the Chief Financial Officer, on the 13th of January 2026. This just solidifies that the information has been reviewed and approved at a high level within the organization. So, what is the story here? The Federal Home Loan Bank of Pittsburgh is essentially being transparent about its borrowing activities. They are raising significant capital through consolidated obligations, which are backed by the entire FHL Bank system, but not the government. This is their primary way of funding their loans and operations. The information in Schedule A, while not the full accounting picture, gives us insight into the scale of their borrowing. It's a reminder that while FHLBank Pittsburgh supports local communities, its financial strength relies on the collective health of all 11 federal home loan banks. Looking at this filing, it's clear the FHLBank Pittsburgh is on solid footing, as it is part of a well-established system designed to provide liquidity to the housing market. The core strength lies in the system's collective guarantee structure, ensuring that even if one bank faces challenges, the others can step in. However, the lack of US government backing is a risk factor that investors and stakeholders should always be aware of. It means careful management and strong financial discipline across the entire FHLBank system are paramount. The disclosures around consolidated obligations signal a continued commitment to their mission of supporting housing finance, but also highlight the importance of monitoring their debt levels and the overall economic environment in which they operate. Alright, that's our breakdown of this Federal Home Loan Bank of Pittsburgh filing. What's your take on how these institutions fund themselves and what this means for the housing market? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.